Good morning, everybody. So while we're getting settled, I just want to tee up, it is a very, very interesting time. It's an exciting time. We are dealing with more accounting standards and auditing standards than we have in about a 10-year period. So it's exciting because there's a lot of change. Whenever there's change, there's opportunity, but there's also a number of different stakeholders, as Wayne said, who are impacted. I'll get back to what we're going to cover, but first let me just introduce my guests. So first, to my right, immediate right, is Jeff Jones. Jeff is the chief accountant for KPMG. He's also on the leadership team, and he has almost 90 people underneath him who are dealing with these accounting and auditing standards directly as he helps KPMG's practitioners advise their clients. Candy Duncan is next to Jeff's right. Candy serves on the boards and audit committees of 3 companies, Teleflex, FTD, and Discover Financial Services. And she also ran, before retiring in 2013, Candy ran Washington, D.C.'s metro region, and she continues and has been an advocate for women in business and leadership, and thank you for that as well. Dave Sullivan is next to Candy, and Dave Sullivan runs Deloitte's national office, and he grew up in the West Coast serving high-tech companies. He's also on the leadership team and on the board of Deloitte as well, so thank you for being here. And then Christopher Tower runs BDO's national office and has also been instrumental in putting this panel together. So thank you very much for all being here. It's great to be here. Before we dive into it, we're going to cover accounting and auditing standards from 3 different perspectives. First, we'll talk about adoption and management's role in adoption and how companies get ready for adopting standards. We'll then talk about the audit committee's role, and we'll not only get a perspective from Candy's having dealt with in 3 audit committees, but also us as practitioners and who are helping advise companies. Then we'll also get in the external auditor's role, and then we'll leave time to talk about the auditing reporting model that's coming out, the new auditor's report that will be coming out very quickly. As I mentioned, a lot of change. Sometimes maybe people who don't live and breathe what we all do, they think, okay, we'll change the accounting policy, we'll have a new set of rules. Unfortunately, it's not that simple. It affects processes, it affects how you inventory contracts, it affects disclosure, how investors look at different companies, and ultimately, if it's done right, it builds investor confidence, and not done well, it can actually erode investor confidence. But it is important to point in mind, every time there's a change, it's meant to build more confidence, more trust in the capital markets. And after a long process of deciding what those standards are, we ultimately land on those standards, but it doesn't stop there. It's the implementation that goes with that as well. Just to tee it up, at PwC, we did a survey earlier this year. We surveyed 600 financial reporting executives, CFOs, controllers, heads of accounting policy. And we asked them with the number of changes coming down the pike. And just quickly, we've just now adopted our new revenue recognition standard. Most companies have done that. We have a leasing standard. We have credit losses that affect many companies, not just banks. And as I mentioned, we have the new auditor's reporting model. So there's a lot coming down the pike. We surveyed the executives in terms of degree of difficulty. 95% of the 600 people surveyed said that it was either very difficult or somewhat difficult to adopt these new standards with the number of changes coming down the pike. We then specifically asked about revenue recognition, and almost 2/3 said the 3 most difficult areas were inventorying what you have, just literally getting your arms around the performance obligations that you have made. They also said that getting the right disclosures that are in place, and then also the variable consideration that goes with that. So it's clearly an area many companies are struggling with and trying to figure out. And with that, what I'd like to do is maybe dive in first to the adoption part of how companies get ready. And Jeff, maybe I'll start with you, if that's okay. So I mentioned RevRec has come. Companies have to deal with that. At what point do companies start thinking about this? As I mentioned, the incubation gestation period for standards is a long period of time. When do companies start thinking about it?
Well, I think it's interesting. I went back and looked at some survey data that we had done, and I looked at 2 different data sets that we had. One was from a couple of surveys that we did of our clients and other stakeholders, but it was a voluntary survey. And then there was another data set that we had that we did some internal surveying of our audit partners and asked them to speak about each one of their clients separately and respond to it. So we felt like we had a complete set rather than just the volunteers who are willing to provide data. We didn't publish that, but that was one of the ways we were trying to track how are our clients doing on this. And what the data showed was that probably at about 18 months out, just about everybody was at least in the assessment phase What was troubling at that point was we were 18 months out, and there were precious few companies that had really moved forward into actual implementation and developing systems, and we thought, boy, that was troubling to us because we knew that the task ahead of them was going to be difficult. We'll get into what some of the reasons for that were. And we saw the same thing when we surveyed our audit partners, although when you brought in everybody and didn't have only the volunteers, the data looked a little worse. And I think it was more truthful that the companies were lagging behind on this. But what we did see was once we got it about 6 to 9 months out, everybody was in the meat and potatoes of doing what they needed to do to push forward and get this done. So, you know, when I started thinking about, well, what were the moving parts of this, and why was it such a big task, and why were companies taking so long to do it? And really, I had 5 or 6 things that came to mind for me. One was just understanding their contracts, how they were going to fit into this new world, and really reading their contracts in a way that they hadn't read them before. As companies started to learn about the new standard, things that didn't matter under the old standard were very important under the new standard, and so there was a lot of effort and eye-opening effort where people on the accounting side really started reading their contracts and finding things that were surprising to them that were going to be very important as they implemented the standard. There was a big education effort. People needed time to understand what the new standard said, how it was going to affect them. There were, over this entire implementation period, there were evolving interpretations as the firms worked through it with clients and other constituents and the standard setters. There was new guidance coming out and changes being made and clarifications being made, and all of those created all these moving parts to sort of you needed to kind of get a stake in the ground, but you couldn't do that if parts of the standard that were going to be important to your implementation were still in a state of flux. Companies started thinking about systems they were going to need to change, processes and controls that they were going to need to implement to be able to manage through this new world. And then the disclosure side of it has proven to be much more difficult than I think a lot of companies believed at the beginning. And there's 2 aspects of that. I think one is there are some qualitative disclosures about disaggregation that are very sensitive and requires judgments to figure out what's the right breaking point, and the sensitivity of that information to some companies has caused some issues. And then just all of the quantitative data that's required to be disclosed requires a lot of work for companies to figure out how they're going to gather all the data. Particularly companies that have multi-locations around the world, have grown through acquisitions. Everything's not on one system, so trying to figure out how to get the data points that they need and making sure they're getting complete and accurate and comparable data from disparate systems that need to come together to produce the information that's going to be disclosed is a big undertaking and more difficult than I think a lot believed when they started the process. The other thing is that the change that's required here crosses organizations. This is not just an accounting exercise. This is, it's finance, it's IT, it's tax, it's HR, it's investor relations and legal. It really just crosses completely across an organization. You need to spend time educating all of those constituents to make sure that they understand what they're going to have to deal with. Think about in a company, people who are out negotiating contract terms over the years would learn where the guardrails were and things to avoid and things to try to get into contracts. They all needed to be completely re-educated on a process that was evolving under their feet to make sure that they understood where the moving parts were that they needed to be sensitive to and raise their hand before they signed contracts to make sure that companies were ending up where they wanted to end up. So I'll stop there.
Maybe just
that was a lot.
Christopher, I'm going to come to you, but I just want to try to make it real because many of you are sitting in front of students day in and day out. And you name any favorite brand name company you want, whether you're selling technology projects on your phones, which my kids are on right now, whether you're doing trucking, whether you're doing healthcare, financial services. What Jeff had mentioned is performance obligations. And you think about sales forces that companies have that number in the tens of thousands. This standard changed the way people account for things, disclose for things, and then ultimately the ripple effect was not just systems and process, the way companies go to market. It was literally the way they contract, what terms, return terms, contract terms, pricing terms, and the like. And when the standard came together, there were two different approaches companies were allowed to take. They could have taken basically what was called the full retrospective method, which is what I call the full Monty, the most work, at least what people thought at the beginning. And you would go back and do a full restatement 2016 to 2018. The other one was basically a modified approach, which still you had to go back, but it was only on current and future contracts, but there was more disclosure. And Christopher, most companies chose the modified approach. Well, why?
So if I had bet at the beginning of this process, I would have thought that more would have chosen the full retrospective. And the reason why I would have bet that is that some of the companies' revenue streams really had significant changes. And so someone would want to see the historical pattern restated to actually show what revenue looked like historically, so you can see the trends and analysis of revenue. But actually that did not prove out. And we've had a lot of discussions, BDO internally, and I've thought about it. I think there are probably 3 or 4 major reasons why this did not occur. The first is just effort. The effort to do this. If you're a large accelerated, you have 3 P&Ls out there, you have to go back 4 years. You have to analyze all the contracts, all the revenue streams. Some companies had 80, 90, 100 revenue streams. So you're talking thousands or potentially hundreds of thousands of contracts. So the effort would have been really, really significant. The second item is cost. So with that effort comes a huge cost. And we're not talking $50,000, $100,000 for large companies. This could be in the millions of dollars, the multiple millions of dollars. So I think effort and cost, the time for that effort. The third bucket, which is kind of a little thought about but very significant, if you are a registrant that changed your auditor, you would have to deal with more than one auditor. So I know there's a lot of love for auditors in the room, but I think dealing with one of us is a challenge. Having to deal with 2 of us, I think it's a little bit daunting. And if you changed your auditing firm in the middle of this period, 2-year, 3-year period, you would actually have to engage a second firm to come back in and revisit you and rethink under the new standard, all the historical revenues recognized. I think that would have been extremely challenging. And then the last is actually, I think the investor community was really much more focused on the prospective view, and that this sort of legacy trend view actually took a back seat. And I think I was personally surprised by that. I actually thought more people would drive or want to see that historical pattern. But the investor community has not demanded it. So I think the modified approach wins.
So maybe just build off of Dave. From your perspective, will there be more work down the road or ramifications for companies choosing the modified approach? Like, how's it play out where it's so early?
Yeah, well, there are certain requirements that are different if you use the modified approach, and I'll touch on those real briefly. But to just add to what Christopher said, early on, as we were working through 606 with our clients, we had a much higher percentage who said they would use the full retrospective approach, and that in those last 12 to 18 months really shifted to the modified approach for all of the reasons that Christopher said. What that did mean then, though, is that companies had to do the additional disclosure requirements that are in 606, which are not insignificant. When you look at the Q1 disclosures, and we did a survey of Q1 disclosures around the new revenue recognition standard, there's a significant increase in the number of pages in the 10Q that are dedicated to 606. And a significant portion of that are these disclosures around the modified retrospective, where you need to show the impact of the adoption of the standard on every line item in the financial statements, including the statement of cash flows. So you can see that would add several pages just in and of itself. Now, on the plus side, you don't have to do all of the things Christopher said you would do in the full retrospective, and you only have to do this in the year of adoption. So I think for most people, that was a trade-off they were willing to take, but you need to keep 2 sets of books to do that, right? You've got to do under 605 and under 606. And then one of the other things that we've seen sort of as an outgrowth of that and thinking about the user side is the additional non-GAAP disclosures that companies have been making, many companies have been making, in order to help users understand the differences between 605 and 606. And if I could just make one other point, this is to something Jeff was saying earlier, the impact of the adoption of the standard was significant, the effort, I should say, was significant, even for those companies who had no material impact. So there was a lot of work that had to be done just to satisfy yourselves that there was no material impact to this standard. So it was not a simple exercise for everybody.
So that's a good segue, Candy, to you. You are serving on 3 boards. Thank you for that service. You've seen it from different perspectives. What's been your role from sitting on 3 boards, and what have you also heard from other audit committee members in the community?
You know, it has been a lot of work, and I think initially the decision was pretty easy to do modified, and then some companies made the decision, no, let's just get this behind us. The one learning that I saw over and over again was start early, have a plan, communicate that plan, and then communicate it again. Because I think that's where companies get in trouble, is when they don't execute on you know, what's out there.
Yeah, because the reality is if in a just-in-time environment, there's too many standards coming down the pipe.
It doesn't work. And from my standpoint, you know, revenue was not as big of an issue as the next 2 that'll follow, the leases and Cecil.
So therefore, the lessons learned.
Right. Start early, don't wait.
Right. Dave, maybe just build off of that. We've talked about accounting and disclosures. Can you maybe give a sense as to the ramification it had on companies' systems and processes that companies had to go through?
Absolutely. You know, this is the systems involved in the revenue standard, and we'll talk about this when we get to leases again, because of some similar issues. The systems side of that is significant. As the process went, you really had to answer a lot of accounting questions first before you could determine whether or not your systems were adequate, whether they were going to provide the right kind of data, gather and provide the right kind of data so you could reach accounting conclusions, you could make the disclosure requirements. And from our experience, companies really ran the spectrum from those companies who started early, planned this out, built out the systems, spent a lot of time and a lot of money, but by the time they adopted, they had systems in place. And at the other end of the spectrum, there were a lot of ad hoc processes that had to be put in place in the short run in order to meet the effective date of the standard. And that certainly presents a lot of risks. When it's not systematic, when it's manual, you've got to have different internal controls. There's a risk that those controls, which now are detective controls, not preventive controls, may not be effective. And you still have the process of building that into your system at some point over time, so the process isn't over yet.
And Jeff, in a second I'm going to come to you, but I just, again, trying to make the linkage to the folks that you're sitting in front of every day. As I had traveled the country meeting with different engagement teams and our staff, what is absolutely remarkable about a standard like this is the opportunity it opens for them to understand the business front end, to understand what a company is really trying to do, to understand how it differentiates itself in the marketplace, to understand how cash flows in the business. And the beauty of getting involved with a standard like this early is it's not just the accounting policy and disclosures. Our professionals, the people you're teaching and feeding into the profession, have the chance to truly understand the business, the controls in the business, how they make decisions. So it is a great opportunity, and what Jeff had covered on, or I'm sorry, what Dave had covered on is we not only look at disclosures, but we get a chance to understand the system side of it and the business side of it as well. And it's a great opportunity to really continue that learning that Wayne talked about in his introductory remarks. So Jeff, with that, one of the things that the FASB tried different here was the Resource Transition Group. Do you mind talking about maybe what that is and then how it works? Because it's been in place for a while and it was new.
Yeah, so the FASB Transition Resource Group was just a forum where issues could be aired and potentially resolved so that they would be retrievable by others that wanted to learn from what was being discussed. And that process really worked great, but there was a lot that fed into it. Before things ended up at the FASB Transition Resource Group, there were things going on amongst companies. They were doing organizing share forums themselves with their peers. They were doing training sessions with the audit firms. The audit firms were putting on share forums to try to bring people together to talk about things that they were seeing and debate, hey, I think this means that, and I think this means the other thing, and realize where there were differences, where companies within the same industry were reaching different conclusions, or when the audit firms would participate in these and cross from one to the next and realize, hey, this industry's saying this and this industry's saying, they're reading the same words, but they're reading them the opposite ways. And that was a way through those forums, as well as an AICPA industry groups, where all of those things could eventually bubble up into the FASB's Transition Resource Group. And this is a great example of everybody working together towards a common goal. And lots of different things happened with issues that got there. Some things just got discussed, and there was sort of agreement amongst the members of this is what the answer should be, and they were done. Others, FASB took decisions to make amendments to the standard in some cases to clarify, to address unintended consequences. And then in others, there were things where the answer was just sort of, well, you can read it this way and you can read it that way, and that's okay. There will be diversity in practice as it relates to this particular issue, and that will be fine. So I think the last but not least, I don't want to forget to also mention the SEC. And I did plan to mention this even before I knew Wes Bricker was going to be in the room. But no, I especially don't want to forget. But the SEC was a tremendous help through all of this. I mean, they did things that I don't recall the SEC staff doing this in the past, where they met with the audit firms to talk about the issues, but there were companies pre-clearing their individual issues, but as well, but most importantly, I think, groups of companies were coming in together and talking to the SEC about here's how we are interpreting this. We've read the TRG minutes, we've read the standard, and here's how we think it applies to this population of contracts that are very common in our industry, and we got to resolution on those things to help build consensus and get companies on the same path. And tremendously helpful to move forward.
I think, Jeff, that's an important call out, and I'll even take a step back. As somebody who spends 50% of his time outside the US, when you look at how the collective system worked around the revenue reckoning standard, there's always room for improvement, to be clear, and yes, it's been a lot of work, but the system works very well. I mean, when you go way back to the beginning of this standard, there was a desire for more transparency and more understanding around what companies were doing from the investor community and other stakeholders. That's what drove the standard at the end of the day. It was years in the making based upon feedback and input, and there were processes put in place both from the regulatory side, the standard setting side, and the professional work of preparers to minimize variability, to make sure that everybody's looking at the same playbook. And we should feel pretty good about our system overall, especially compared to other systems that we see out there. And it's a good call out when you look at the whole system. Maybe, Candy, one last point before we wrap up this point. A couple of us have mentioned investors and other users. They had to be completely re-educated. They've been looking at it one way for decades, and all of a sudden there's a new way. Maybe, did you see some best practice how investors were educated?
The collaboration was phenomenal. I think industry groups really came into play. That was something that I saw, and I think you mentioned that, Dave. It's really encouraging to see how people were working together to make sure that the investor base was educated and that they would understand as the changes were coming about. I also think the non-GAAP disclosures, which I think, Chris, you mentioned, that was something that we saw where there was confusion or there was thought that there might be confusion. Non-GAAP disclosures were added. So, the investors are the last in this line and in the chain, but they need to understand, what's being communicated.
Great, thank you for that.
Tim, one thing I'd add to that is for certain companies where 606 had a significant impact, they had separate investor calls to just walk through what the transition to 606 was going to mean to future reporting before that first quarter of reporting happened. And I think for those companies, it was really important for them to do that so that investors could be working on models before they saw Q1 numbers.
Great. So Dave, let me stay with you. So as we wrap up what we call this first part of this panel, the adoption phase, maybe final thoughts, and I'll ask for you. Several people have said, including one on this panel already, that revenue recognition is one thing, leases are very different. So maybe two things, like why is it so different? And then what lessons learned do people have now, having gone through revenue recognition, knowing there's more coming?
Well, let me say a couple of things about that. First of all, I think, and Jeff mentioned this, I think everybody underestimated the importance of thinking about disclosures early on. And that, when we get to leases, you know, that will be the message you'll hear from everybody, is all think about disclosures early on. For many companies, the accounting conclusions that they reached in 606 are significantly different than what they had before. And so that was part of the complexity and making sure you got it right, so that as you start issuing this information, it's really important. We'll just see in leases, while there are some issues, I don't think, for the most part, they're going to be as complex as the revenue recognition ones were. But there are a lot of, and Candy mentioned many of them already, but there are a lot of lessons to be learned in this next phase. Great.
So Christopher, maybe too, you're in front of a group of preparers, not this audience, but imagine you're in front of a group of preparers or companies. What advice do you have for them, having been through revenue recognition, knowing what we got coming down the pike?
Run. No. That was, okay. My attempt at humor, accountant humor. I think these standards, as we give the advice, I just want to step back to the lens. One of the issues we had with this standard is that a lot of people thought immaterial, no impact. And once we delved into it, it wasn't immaterial and it wasn't no impact. And so I think it requires a lot of depth. So go early, if we're talking to preparers, go deep. And as Kenny said, put a really strong accountability plan in place. You know, something that has specific targets for understanding the standard, for assessing and aggregating and assessing your contracts, for applying the standard to your contracts, and then looking at the actual accounting determinations, and finally the disclosures. I think having that sort of accountability in place and having everyone meet regularly to go over that, which we found a lot of shops not doing at the beginning, and finally they realized they need some real rigor to this, some real process. Without it, you're destined to fail, or at least to be a very, very bumpy ride. A couple other things that we have found: engage experts early. So often companies, especially in the middle market, don't have the necessary experts on board, and you need to engage them early. And why do you need to engage them early? One, because you need to make these assessments early. Two, because they get grabbed by everybody else. This U.S. marketplace has a limited, finite body of resources available to you, and if you don't engage early, then you're going to have trouble engaging. And then last but not least, I think one of the most important things is, while you're struggling with the rigors of the standard, you need, and I think several of the panelists talked about this, you need to be really thinking about the gestalt for the organization. You need to be thinking about controls. You need to be thinking about your processes, and you need to be thinking about the systems. And so what we're dealing with right now in Q1, Q2, and Q3 is there were a lot of bolt-ons done. Manual process, manual controls, spreadsheets. And now companies are going through the rigor, post-implementation of having to build those things. If in the next standards we can actually do that, and if the companies can do that while they're evaluating adoption, so that day one they're there instead of dealing with bolt-ons and manual processes, I think we'll all be a lot better off.
Maybe before we wrap this up, I'll just make one comment. I'll share with you a brief story, and I'm going to end up dating myself. But when I was in the mid-90s, when I was at that time, had just become a new partner, the derivative standards were completely rewritten. And one of the partners, who was my mentor, had said to me, she said, this is a great time because everybody's at the ground floor, and you can learn the business and you can learn this no different than anybody who's been in the business for 30 years because the rules have been completely rewritten. And this is one of these times. As you sit in front of students, this is a great time to sell how exciting it is. Because whether someone's joining in a preparer or the profession 1 year, 2 years in, they have the same level of knowledge as everybody else because the rules are completely rewritten. It is a great opportunity for them to truly learn the business, truly learn the reporting side, the control side, the process side. And I just ask that don't lose sight of the big why. The big why here is the investor community and other groups and other stakeholders wanted more transparency and understanding around what companies were doing. And as we go into a digital age and a more complex world, the standards are keeping up. And it is a great time for students to come into this world and be at the same level of footing as any of us who are sitting up here. So I don't want to miss that big why. Yes, it's a lot of work. Yes, it's hard, but it is a great opportunity for them to start their careers and an exciting time to really, really move ahead fast.
And Tim, maybe to add to that, your students have the technology skills that we didn't have.
Yes.
And their controllers and their bosses, don't have those skills. So it's really an asset that they bring to the table. And when it comes to revenue rec or leases, they really hinge on somebody with good technology insight, being able to put all the pieces together and be able to solve the problem. And they won't be the one cranking it out with a 10 key, but they'll be the one that is really looking at how it's being driven to the ultimate answer.
Thank you for that, Candy. Very well said.
Tim, one
Kristen?
thought for the academic community in the room, and we talked about this in preparation. Probably many of you are already on the way to do this, but to build a multi-course case study that looks at the adoption of a standard could be a very informing, molding experience for young professionals. And we were batting this around on one of our calls, and I thought, wow, I wish I had that when I was in school, and of course we didn't back then. But this is a wonderful opportunity for the academic community to take the lessons learned, meet with firms, get information, and then take that and build multi-course case studies that follow through the auditing, accounting, controls, financial reporting elements of this. It could be quite exceptional.
Great. So now let's go to the next element, and we'll move a little bit off of revenue recognition to a broader point. When you look at the audit committee, they're a critical stakeholder in these entire processes. There's the profession prepares, the audit committee, and other groups. And there's, as we said earlier, a number of different accounting standards and auditing standards coming down the pike. And Candy, maybe I'll start with you. What is the audit committee's role, and when do they get involved with something like this? Because none of these standards come out of nowhere. Like they're, right, as you said, out for years. So maybe your perspective?
I, again, think you need to get involved early. When a standard is passed, when the FASB's issued something, audit committee should be involved. And they should be understanding not only the standard, but how it's going to impact the company, but perhaps also what the company's plan is for implementing that standard. I'm a big believer in, it's not what you expect, but what you inspect. So let's have a plan and inspect it along the way. There's lots of hurdles, there'll be a lot of decisions, and the audit committee should be knowledgeable about all those different steps, how they're proceeding along the path, the decisions that they're making, maybe even what is coming back from different groups, NACDs, Center for Audit Quality, the firms. They all have different opportunities to learn more. Take advantage of that. So you can have knowledge as you're sitting in those meetings, and perhaps as you're communicating on up to the board, what this is going to mean, and what are the things that the company's thinking about, and what should the board be thinking about as well.
Great, thanks, Candy. So maybe just best practices that any other panelists have for engaging audit committees on something like this?
Well, I'll start. With some of the most effective audit committees, it's often about how curious they are about the plan, because our management will present an implementation plan, but being able to ask those questions about what are the risks in the plan. You think about leases, for example, and really the significant shift from just disclosure to recording these on the face of the financial statements. And what are the real risks around completeness, for example, that you've actually identified all of the contracts, you know, that maybe the controls have not been quite as precise when it's just a footnote disclosure. So getting in and asking those questions so that management is really thinking about and being honest about the challenge that's ahead of them.
Jeff?
Yeah, I think that's exactly right. I mean, what we're finding is the problems companies are facing with the leasing standard are really logistics. They have, in some cases, thousands of leases that they need to sift through. And when you're the lessee, almost none of those leases are the same. So you have to find them, figure out how they're laid out, sort through the various amendments that have been made to try to get at just what are the basic facts that I now need to account for. The accounting model is relatively straightforward. It's the logistics of getting all this information pulled together. And I think audit committees need to be aware of, well, what are the logistical problems that this company is facing, and really dig in a little bit deeper to make sure that they're addressing them and have a plan to get there.
Yeah. Christopher?
Consistency and depth. Part of a firm's issue is we're only as good as our teams that are in the field and dealing with the client. So it's about the firms providing the right structure and resources to allow teams to execute consistently with audit committees on matters like this. And if the firms haven't provided the right tools to its engagement teams so that in the right structure as to what the expectations are for communication interaction, you're going to get a disparate sort of outcome. Some companies will have good outcomes depending on the engagement teams and others won't. So I think one of the things we learned through this exercise is consistency of approach and supporting your teams so that we provide the best quality and level of interaction with audit committees around the adoption of a standard is really, really important to make it a successful event for both sides.
Yep, so I offer a bit of my perspective building off of this. One of the things that continues to impress me day in and day out is the work that partners and engagement teams do all across the country. And one of the things, I actually have a piece coming out relatively shortly that I'm going to be publishing. I think the work that the auditing profession does is remarkable. And Dave, you had said that management needs to be honest. I'm going to tweak that. Management tends to be optimistic. They tend to underestimate the amount of change. And some of the best work our partners do is the finesse of helping them realize that they're being overly optimistic. Right. And recognizing there's a day-to-day relationship that's always independent, but some of the best work that our engagement teams do are the ones where they help management get to the table and say, we need more time, we need more money, we need more time on the audit committee agenda to talk about it. And it's that work that partners do to help that controller, that CFO, get in front of the CEO to say, it is going to affect sales compensation, it is going to affect the sales process. And that's the stuff that I worry sometimes doesn't get written, doesn't get told, because we always talk about interpersonal skills when we're talking to you. I'm getting more specific. These are the interpersonal skills that really help the financial reporting system work, because our partners are making that happen across the board, and you all see that in your practices.
Absolutely. One of the things we talk about are the press sees negative moments, yes. But Cindy, at the CAQ, we've talked many times about safe landings, right? Yeah. And there are thousands of safe landings that happen every month between the interactions with the profession and their clients, the issuers, community, and so you're talking about the successful interactions, and there are a lot of them. Yeah. Unfortunately, we get to see some of the bad ones.
There's nobody closer to what is actually going to be produced from the company standpoint than the auditors. Mm-hmm. And that is really a service they provide. Just last week, one of the audit partners made a comment on something, we're 2 years out, but her comment was, well, it's going to be harder than they think. And it'll take more resources, and it's going to be difficult because they are putting themselves in the chair of management at that particular time, knowing enough to know what it's going to take to get the job done. They also know that somebody's got to come behind and check it, right. And all of that, it's the process before it even comes to the audit committee. And I totally agree, where the people that you're teaching that will be out in the field can really be of value is when they see this road having some bumps, and it will, communicate those.
Yeah, absolutely. That candor is important. Candy, maybe I'll stay with you. When you look at a standard that maybe has a 2-year runway, what's the frequency on the agenda? Like audit committees meeting 6 to 10 times a year, depending on the company. What's the frequency with which you touch it on different audit committees, and perspectives as to what the right balance is?
I think it really depends on the materiality.
Yeah.
If you take the credit losses, CECL, that's going to be on, a financial institution, a bank.
Yep.
It's going to be on their agenda every meeting.
Right.
Where are you on the plan? It's complicated. What's happening in the industry? Any changes within the profession? Very different than maybe something else that is very immaterial or really doesn't come into play in a different industry. So I think it really depends. The audit committee, management have to have good communication on that. Mm-hmm. You also have to have good knowledge coming from the firm, outside entities, and maybe industry groups, because you don't want to be out of step with what is actually going to be the final product.
Yeah. And especially when you talk about something like CECL that has such broad ramifications on things like capital and regulatory reporting as well. Yeah. So maybe Dave, I'll start with you, but I want to tee up this question. For the audience, think of not only the message of how we communicate to our partners, but the scale. So when you think about the 6 largest firms, there's anywhere between 500 to 1,000, 1,200 partners. So you all have the privilege of leading those partners. So not only what are you telling your partners about the standards, what to communicate and when, but also how do you manage the scale of what you're sitting on top of? So Dave, maybe start with you first.
Well, happy to. And as you can imagine, it's not just the breadth of the partnership, but the extent to which something like revenue, for example, the impact that it had. And frankly, we've talked about public companies who've now implemented this in Q1. We've got 4 times as many private companies who still are facing implementation this coming year. So, it's not a project that's over from that perspective by any means. But we started with education early on, from whether it was internal education to providing materials to engagement teams so they could work with management and with the audit committees to educate on the new standards. So that the process would start, the conversation would start, the planning would start, so that we would start to see a plan out there. We worked with, in the national office, we have, I don't know, about 150 or 60 partners and directors in our national office, and many of those were really part of engagement teams and working with the engagement team to present to audit committees, to work through accounting issues at our clients and on a real-time basis and that sort of thing. And then we had a lot of processes, as you can imagine, to monitor the implementation of the standard over the last 24 months before the effective date, to do similar to what you were describing, Jeff, working with engagement teams to understand the level of engagement of our clients and their audit committees, to understand are there concerns that we need to be raising to the audit committee. We have required communications if we have concerns about the company's ability to adopt the standard. And so it's extensive monitoring systems to make sure that when we do come to that point in Q1 where the standard gets implemented, that it is a safe landing. I will say, just as a little anecdote, we figured, since you're working on all of these accounting questions, Jeff, I don't know what your experience was, working on all these accounting questions up to the beginning of 2018, once we got to Q1, we thought, well, maybe the accounting questions will subside a little bit as people now have the answers. They're recording this. I see Jeff shaking his head. We were surprised at the uptick, even in Q1, of the questions that we got. And I suppose some of that may have been as people are actually sharpening their pencil and actually booking a journal entry, neither of which actually happens, I understand, in the computer environment. But as they are actually recording revenue under the new standard, they're making sure, this last chance that they're getting it right. So it was it's a monumental task, and those same processes are, we have in place now for leases and CECL. And frankly, also accounting for tax reform, which has to be done by the end of this year. Just another, we haven't been talking about that. That's not an accounting rule change, but it certainly has a huge impact on our clients.
So Christopher, maybe your perspective, anything to add?
Yeah, the process was almost overwhelming from the firm perspective. And I think I would say ditto to everything that Dave said, including that the pencil and those things don't happen. We're a little smaller, so we have a partner group of 500, so maybe 300 audit partners. We're able to do a lot of conference calls and a lot of live interaction or interactive sort of settings with our partner group, and that helped. One of the things that we found in this process of getting everyone ready and interacting with our clients is the state of readiness that we dealt with, which I think several of you have addressed. I think, Jeff, you started with the discussion with it. And getting over the hurdle of that state of readiness was really a challenge. And we found the audit committee to be the cornerstone for helping. So we started multiple dialogues. We had discussion templates for quarters to engage with management, engage with teams. And you would get, it's immaterial, it's not going to be impactful. And you had clients wanting to make those disclosures when we, from an attestation perspective, are uncomfortable with. So when making disclosures around a standard when they haven't finished their work, we engage the audit committees. And it actually, from a firm level perspective, I think that caused a unique and deeply engaging activity audit committees that may heretofore in some client relationships had not occurred. I think this standard created a lot of good things. You know, it's a type of unfortunate engagement you have with the audit committee when you're dealing with a 10A matter or something like that. It's really deep, right? You're really involved with the client. Now, this was a positive matter. It's an adoption of a new standard. I guess positive depends on the eyes of the beholder, but it caused real deep engagement. I think in that engagement between the audit firms, I'm sure all the other firms present in the panel felt the same way, that creates a better product. It creates better identification of risks, it creates handling issues up front and more timely, and it creates ultimately a better work product as to how disclosures are made and how things are accounted for. So I think we did a lot of, I called it mano guerrilla warfare from our firm's perspective, and we deepened our connections with audit committees probably deeper than they've ever been.
That's terrific. So let me, as we wrap up the audit committee section, I'm going to ask a couple of you just to last minute questions or last wrap up here. And Jeff, I'll start with you. What questions would you advise audit committees to ask of management or the accountants?
Yeah, I think what you want to get an audit committee to focus on is where do we stand? Yeah. What are the problems? Are we going to be ready? What are the risks in the plan? Do you need more resources to get at whatever this problem is? And you know, let's get them done. And then, are we making the right disclosures to the public? If we think we've made progress, you know, the SAB 74 disclosures ask us to. That's supposed to be a living disclosure that's tracking the progress that the companies make. Are we making that? Are we an outlier on any of the? Are we hearing that we're an outlier on anything we're either planning to do, planning to disclose? Any of that kind of stuff is the kinds of questions that I think you want to try to get surfaced, that sort of move beyond you know, it's a standard, we're working on it, and we'll adopt it in 2019 and everything's fine, everything's on track.
Christopher, maybe from your perspective, we have the academic community largely here in front of us. What do you want to leave them with in terms of the role of the audit committee when we have new standards?
So, actually, this is something I've taken some time to think about. I guess the audit committee really has a critical role, a critical oversight role. And in some audit committees demonstrated that and others did not. And large and small, some large, very sophisticated issuers where the audit committees didn't, and some very small ones where the audit committees did. So it wasn't a size matters issue. It actually has to do with tone. And we think cultural tone is a big deal here. And so we think the audit committees really have a responsibility to address with management and hold them to both an action plan, so have them provide an action plan, and actually get regular reporting on that action plan. I think you asked Candy what kind of frequency. It sounded like it was maybe quarterly. But some sort of action plan. In that action plan, there should be disclosures, as Jeff mentioned, as to risks. What are the adoption risks? What are the risks that are going to prevent appropriate accounting and reporting and hitting disclosure deadlines? And then there's another aspect of that, which is identifying issues. So, for example, one of the biggest surprises of the revenue standard is the impact on 605, that 606 informs. So, Jeff, you mentioned, and Tim, you mentioned the deep dive that people did looking at contracts. And I think it took audit committees by surprise to find out that there may be a 605 revenue recognition issue that was informed because there was such a deep dive into contracts under 606 it turned a light bulb or a flashlight on to 605. So I would say that audit committees should be inquiring of management as to are there any bombs there, both in past or prospective accounting issues that they need to know about. And I think that's a really important piece of it.
So Candy, you deserve the last word here, given that you're sitting on 3 audit committees.
I am. I would just say start early,
Yep.
develop a plan, communicate, make sure you've got the resources that it's going to take to be able to deliver. And no matter when you get started, it probably wasn't soon enough.
Yeah.
So you need to make sure that that is, you know, constantly being monitored. Ideally, you want to have time to run parallel so that you know what the changes are going to look like, what the differences are going to be, and then you can start educating the next group, be it investors or people with inside the company.
Yeah. So Candy, I just want to build off something you said earlier, because I think it warrants pointing out. You had said to this group, encourages students to speak up when they come here, because audit committees want to hear that. I have the privilege of going to about 75 to 100 audit committees a year in the role that I play now. And I often get asked the question by audit committees, what more can we be doing? And the best ones ask those questions all the time. And the piece of advice I give them is, ask your auditors what they say about us when they're in the room alone. So if you know anything about auditors, we generally sit in a room, and when we're by ourselves, we talk. We talk about opportunities for improvement. We talk about weaknesses. We talk more candidly sometimes than we do in front of an audit committee or we're in front of management. And the best audit committees create that environment to do exactly what you had suggested. And whether it's on a new standard, a financial reporting matter, that advice, if we can all continue to pass on to audit committees, because the best ones do that, and that allows that free-flowing conversation that ultimately gets to the high quality of reporting that we want. So
We're in it together.
Without a doubt.
And
absolutely.
so we all need to work together.
Yeah.
And that is not only the external auditor, the company, management, audit committee.
Yep, completely agree. And
Tim,
that's a
Tim,
good.
if I could just, I know Candy had the last word, so we'll insert this in the transcript before your comment. One of the questions audit committees can ask as we're implementing these new standards is, we have regular communications with the audit committees about significant risks. And one of the questions is, will the adoption or the execution of this new standard give rise to new or different significant risks as you execute your audit? And that, as we get to CAMs, that will also be part of that important discussion as well. So I think it's another way of looking at this to see from the auditor's perspective, is this just an adoption exercise, or does this change the risks that we're addressing in the course
So that's
of
a
the audit?
perfect segue. We've covered it from the adoption of management. We've talked about the audit committee. Now let's go to the external auditor role and the role they play. And Dave, I'll start with you. So standards, again, as we've said, they gestate for a long period of time. When do you advise teams to begin to engage with a preparer and the audit committee, from your perspective?
Well, we've said it over and over again this morning, but early and often, and certainly with the new standards that are out there, we work on educating our clients, management and the audit committee, even in the deliberation phase, so that people are aware of standards that may affect their company and can be involved in the process, because it's important to make sure that we encourage that involvement in the standard setting process. I will say for the most part, the way it works is management really does take responsibility. They own the financial statements, they own the adoption of the new standards, and they want us to be there with them, to advise them appropriately, to advise them as they go through and do these analyses and that sort of thing. But I would say, again, it's early and often, and I think it's in the best cases, it's also probably never ending, because we continue to have those discussions, and I think in that collaboration between the auditor and management, we actually get better results for investors.
So Christopher, maybe I'll come to you, and we've talked a lot about reporting, and we've had a couple mentions around internal controls over financial reporting. And I know from my own experience, people often focus on the reporting and the accounting side, and the controls lag. When do you see the control side of the discussion getting played in? And having been through RevRec, the public companies, what advice do you have around internal controls over financial reporting going forward?
So what's interesting about the standard is you bridge a year end, and we had several discussions on this matter with the OCA, and in trying to think about the control environment prior to, point of, and post. So, prior to and point of December 31st, if you're at 12/31, you have basically disclosure controls you're dealing with, because day one accounting actually hasn't occurred until the next day, right? So the actual ICFR impact for day one accounting is now. It's Q1, Q2. And I don't think that story has been told yet. I think as firms look at the change in controls, which is a requirement in quarters, and they start doing their work for the year in ICFR work, we'll probably start seeing some real challenges with respect to the internal controls over both the accounting for revenue recognition and disclosure. So it was a very interesting dialogue. I would say that firms probably did not delve into the actual accounting ICFR as of year end, because it wasn't day one accounting. The ICFR becomes then a risk assessment issue for accounting firm if the companies aren't well informed in terms of putting all the right processes and controls in place, then that makes a riskier environment for us. And so it raises our risk assessment with respect to those processes, those controls, and you end up doing more work, and the client ends up having a much more manual set of processes in order to handle it. So I think going to the ICFR impact, we're in it right now, and I think that story is currently being written. It'll be very interesting when someone does a recap of the number of significant deficiencies and material weaknesses disclosed in public reporting. It'll be very interesting to see, material weaknesses, very interesting to see when those are disclosed, what level and number there are. There's probably going to be a spike, I would imagine. Yeah.
Jeff, in a second, I'm going to come to you on leasing, but maybe a comment for the group on ICFRs. Again, I mentioned I spent quite a bit of time outside the U.S. The quality of management work and auditor review of ICFRs over the last 6-7 years in the U.S. has been remarkable. It's been remarkable. And when I look at our client base and I look at our auditors' preparedness to review what our clients are doing, it's night and day from where it was 6 or 7 years ago. From my perspective, we need to get the international community there, because there's a big gap in terms of the focus there. But it still, at times, it does come a little bit too late, Christopher, to your point. Right. And we look at these new standards, notwithstanding all the great progress we've made, the focus on ICFRs and these new standards has to be right up front with the reporting as well, because it gets all the ripple effect that we've talked about, systems, compensation, and the like. Jeff, maybe from your end, we've said leasing's different. Maybe some specifics with leasing coming next. What are some of the things we're talking about with our audit teams and partners about leasing in terms of what to focus on?
Well, as I said earlier, the leasing, the problems are really more of logistics, of getting your arms around all of the leases that you have, which ones meet the definition of the lease, finding the lease contracts themselves, as well as the embedded leases that are embedded in service contracts that companies have. Those are where we're finding the biggest problems as far as at least getting started. The other big issue that we're finding that companies are facing is the system side of this, is that there are many software vendors out there. The software vendors have not yet delivered all of the functionality that companies expected to have by now, so that they'd be in a position to adopt the standard, and they're now, companies are right now, as we speak, sort of figuring out, are we going to get it in time, or do we need to go and start putting forth some kind of a plan B of a bolt-on, some manual processes, so that we will be in a position to report what we need to report next year, and we'll get this all implemented post-adoption. And they're just sort of working with their vendors to figure that out now, and I think that's going to be an important thing for audit committees to start focusing on, is a very specific thing that's going to be company by company as to where they stand and how they're going to react to that.
So Dave, maybe just building off of that, there's now under leasing and CECL, there's a lot of data gathered that hasn't been gathered before, completeness, accuracy, and there's a lot of assumptions that are being made. How are we thinking about getting external auditors ready for risk assessment and reporting and the work around data and assumptions?
Absolutely. It's, there are, while there are lessons to be learned from 606, these are the areas, as Jeff said, where there are some unique factors with leases and with CECL, because there's data gathering that maybe wasn't gathered before to be used in those assessments. Or maybe it's been, and with leases, this is very common, maybe leases are maintained in host countries all around the globe, and just getting those into one spot so that you can actually analyze them, read them in a language that you can read, and that sort of thing, to make sure you've accounted for them right, and that sort of thing is really important. As we've worked through these things, risk assessment is the foundation of what we do in the audit, and so we're working with engagement teams as they assess the plan and look at the adoption of these standards to look at those areas where there might be new risks, which is why I brought that up before, and especially if I just use leases as the example, just the completeness and accuracy of the population of leases could be a significant risk, depending on the number of leases and the impact that will have on the financial statements. So we're going through and helping engagement teams assess those items, but also encouraging now the conversation with management about those items, because if we're going to be thinking about them, we want management to think about it first and to have a shot at getting it right.
So Candy, maybe from your perspective.
It's really resources. Yeah. That's what I've been worried about as an audit committee member. Actually came up a couple times in the last 2 weeks. Are there really the resources either within the company or have they brought in external proven resources that they know are going to be able to deliver? And even from an IT perspective, one of the companies is having to use the cloud. Yeah. Do they have the resources from a technology standpoint? And so yes, they've got a plan in place. Yes, they've identified the critical issues that they think they're going to need to address. Now it's a matter of getting it done, right, and making sure you're not up against, the clock, right, to be able to deliver. So there's enough time for review, there's enough time for the external auditors to take a look at it. I think the real key in my mind is resources when it comes to these next two standards. Yeah. Because both of them, if they apply to the company, they're going to be big and they're going to be complicated, and it's going to take time.
Yeah, without a doubt. And I think one of the things you would emphasize when you talked about the credit losses, if you're a financial institution, this is your lifeblood. If
Absolutely.
You're in retail, leasing is your lifeblood.
And it drives, right, so many other things, as I think Dave and
Yeah.
Chris have brought up. Right. Whether it's capital, right, whether it's loans, just the look of your balance sheet, right, let alone your P&L, it's going to be very, very different. So right, in my mind, the entity's got to have enough time to run parallel for at least a year. I mean, that'll do two things. It'll probably bump out some bugs along the way, which there will be, and it will also give them a chance to know how they're going to react to investors, to lenders, credit agencies, et cetera.
Yeah. So that's a good segue to the last part, and just for the audience, in about 10 minutes we'll come to Q&A for you, and we have plenty of time for that. But the last thing we wanted to touch briefly is we wanted to talk about the changes, upcoming changes in the auditor's reporting model. And in fiscal 19, companies with June 30 year ends afterwards in fiscal 19 will be the first ones to adopt the new audit reporting model, which for decades has been unchanged. And now we're going to see a new change, and it gets to, Candy, some of the things you talked about, which is where the auditors see the risk and their viewpoint in terms of what's happening at the company. And on Tuesday, Cindy will be leading a panel at the AAA that talks about this in detail. But given that we're talking about standards, not just accounting but auditing, it's worth touching on here as well. And the cornerstone of the new auditor's report is the disclosure of critical audit matters, or CAMs. And so, Dave, I'd like to maybe start with you. This has been out there for a while. We've been working on it. Maybe what are you doing at Deloitte, talking with your partners, getting ready for this, and then how you're engaging with audit committees?
Absolutely, absolutely. Well, it's interesting, this proposal from the PCAOB are now final standard, but the original proposal first came out five years ago, maybe 5 or 6 years ago, and we started piloting based on that proposal at that point in time. And knowing that it was continued to be on the agenda of the PCAOB, we were doing a limited number of pilots each year. But with the final standard now that's out there, we're working with engagement teams, with management, and with the audit committees to educate and also do dry runs on all of our large accelerated filers. As you pointed out, the June 2019, June year ends of 2019, so right about now, next year when we come together for this conference, there will be reports out there with CAMs in them. And so we're working on dry runs with every client, every large accelerated filer a year before that, so that everyone can see the process we'll go through, what the wording might look like, understanding that as we get more experience, we may refine things a bit, what sorts of things would be identified as CAMs and why. And it also gives management an opportunity to consider the disclosures that they have about those matters as well. So having this extended period of time and the rolling effective date of that standard, I think, is really helpful.
So, I think the other thing that we may see is companies looking at their disclosure in the 10K this year. I mean, theoretically, the critical accounting estimates ought to mirror much of what's going to be actually in the opinion. So that's one thing we've asked the companies to do. From a board audit committee perspective, take a look at what's in there. Obviously, other things can come in, but I think that's an important step.
Yeah, we're doing exactly that. You know, because the definitions, while they're not exactly the same, there is a tremendous amount of overlap, and I think the greatest pressure will be when there are differences, when there's a CAM that's not a critical estimate, and vice versa. And so I think that there's a lot of instances of companies going through. I think it could be an interesting academic study to look at what did companies disclose in 2015, 16, 17, and 18, and I think you'll start to see some evolution of things that probably weren't critical accounting estimates maybe ever, or certainly not anymore, dropping out of the disclosures as companies start to think about, well, is that really significant, and my auditors going to be on the same page when they get to issuing their reports? I think that's a big part of what we're doing with all of our clients and engagement teams now, in addition to the dry runs on some of our larger filers.
And Candy, if I would infer from your comments, you're saying you don't want any surprises, so let's have the dialogue.
Exactly.
Yep.
I mean, no surprises is the exact message that we've had as an audit committee. We've seen 2 out of the 3, mock-up types of opinions. Now, granted, things can change. Lawsuits, I mean, the Tax Act. I mean, some things might come into play at the very last minute where it might not be directly aligned, but part of that has been an education. And nobody likes surprises, and let's just make sure we're all communicating.
Right. So, Christopher, how are you handling it with your teams in terms of asking them to engage with management or audit committees at this point?
So, ditto. A lot of the points have already been discussed. So, I mean, the reality is it's all preparation and communication. So we've gone through the same program that Dave was talking about, which is educating everyone, going out to audit committees and discussing the standards. So we have a program now where we reach out to every audit committee of every client to discuss what they want to discuss, and of course, CAM seems to be, accountant reporting model seems to be one of the topics du jour. One of the dialogue items that Jeff mentioned that I think is real critical is this sort of dialogue around what does this inform other disclosures within the document. So CAMs, as CAMs evolve and we determine what are CAMs and we engage in that dialogue with management, with the audit committee, I think there will be informed disclosure in other parts of the document that will evolve. So I agree with your statement. I think it'd be a very interesting academic study to follow evolution of disclosures in the financial statements that relate to the CAMs that are disclosed in the audit report. We've done the same thing. We're doing the 1 year before concept. So every client, we will be doing a dry run 1 year before, and I think in a couple days we'll be talking about those dry runs. So we won't go into what those are showing right now, but they are great processes and great forms of interaction between the company and the audit committee and the firm.
Great. So maybe last question, and I'll ask Jeff with you. The concept of critical audit matters is not new, it's new in the US, but the UK has had key audit matters for now a couple of years. And I might ask you, Dave and Christopher, what's been your firm's experience in the UK with key audit matters, and how will that inform what we do here in the US?
We're spending a lot of time trying to leverage the experiences in the UK and other parts of the world where they've done this to try to learn from them not only what they disclose, but the processes they put in place within the firm to control it, because you want to make sure that there's some consistency and quality in the reports that a firm puts out into the marketplace, and that so we're trying to learn what worked for them and what didn't work, so we can get a good outcome.
Dave?
What has been useful from the experience, first of all, I would say we're doing just what Jeff described as well. What's been useful, especially with respect to the UK, is that they've now got multiple years of experience, and the KCAMs that they're disclosing have evolved over time. And so learning from that and why that might happen, I think is useful. The definition of a CAM in the international standards and US standards is not exactly the same. And so I expect we'll probably see some difference there. And we're working a lot on designing and implementing the quality control system, as Jeff described, over CAMs, because you want to have you used the word consistency. It's a great word. We want to have consistency without having the boilerplate language. It needs to be specific to that client, but we need to make sure that it's also informative. And you could run the spectrum from not saying enough so that it's not meaningful at all, to saying so much that you lose the reader in the process. And we want to remember that this is really a phenomenal opportunity for the auditor to communicate what we did on those most important matters in the audit.
Chris?
So our UK firm got the award for the most voluminous KCAP. I think they got a special award for it, actually. The most informative. I'm not sure we're going to emulate that model. So actually, I've had a lot of discussion with the UK firm around the process, and as Dave describes, the quality control systems, and it is really important. So we're actually centralizing, based upon those discussions, and trying to, as Dave indicated, get some level of consistency. You don't want them being some standard one-size-fits-all approach. So you do want context going into the CAMs, but you do need a quality control function over them. So there are issues, and these are some of the things the UK informed us of, which is the issues of omission and the issues of excess disclosure. Issues of omission create issues that you didn't disclose something that should have been there, and the issues of excess is you create a pattern of disclosure that people expect every year going forward. So that was one of the very interesting, informative insights that our UK brethren have informed us of. So we've centralized a quality control group to specifically review CAMs for every single issuer. So before they go out, we'll look at risk assessment, we'll look at the nature of the engagement, and make sure that engagement teams have captured what they should have captured, and that our dialogue, when you see something from our firm, the dialogue is in a similar form and in structure. Maybe the content's different, of course, predicated on the company.
One thing I'd add, Christopher mentioned a couple of the pitfalls, and they're important ones. The third one that we have on our list that we're sensitive to is as you're drafting a CAM and making sure that it sounds good, that it's useful for users, you want to also take a step back and make sure when you get to the end that it's accurate, that you actually did what you finally got to describe that you did. And you know, because you go through review processes and someone says, oh, you would have done this and this sounds better, and at some point you may be implying things that you know
that's a good point.
aren't accurate.
Very good point.
So
That's a really good example. Oh, sorry.
I want to make sure we have time to go to Q&A, so I'm going to stopping with accuracy is a good place to stop. So what we want to do now is give you all the chance. We've got 15, 20 minutes to go to your Q&A, so it's probably a good time. We've covered an awful lot. Thank you for bearing with us, but I'll see if we'll start with anybody who wants to go first. Yep. Thank you.
You were about to give an example. I want to hear the example.
I'm sorry. Here you go.
So just one of our engagement partners who works on a large global account was doing one of our dry runs, and he was talking to me about one particularly difficult thing that he had on what the CAM that they had identified was one that reached around the globe, and so engagement teams around the world were addressing this same issue. And what he realized as they started to write the CAM was, boy, when you're starting to describe exactly what you're doing, you start to find out, oh, the guy in Japan's not exactly doing that, and the one in India is doing something a little bit different. And realizing that is, it's not that there's a problem with the audit, but you have to figure out, okay, now what are we going to do? Are we going to have all these different things in the CAM, or are we going to rationalize the approach of how we're auditing this area around the world? And it was an issue where it just became, he realized how much harder this was than he expected it to be.
Right.
Great, thank you.
Thank you.
Hey, Jim. Scott Shearwalter, NC State. I read a lot of articles about how companies using technology, particularly bots, to be able to solve some of their accounting. So I'm interested in, have you actually seen your clients use technology to come up with the right accounting, and how did you deal with it? And did you even use technology to audit their technology? That's where I'm interested.
I'll maybe start because I did see it being used on leases, or is being used. I think that's a great example where there's a lot of data. It's got to be accumulated in a variety of different ways, and it was a very effective way to be able to come up with solution. Now you've got to be careful. You know, what goes in is what's going to come out, so you've got to make sure that all of that is being handled properly. When it comes to CECL, there is so much data that, to me, that is going to be the ultimate use. One of the companies that I've been working with, they're using the cloud because it is more complicated than what they actually have been able to do within their normal systems. So technology is absolutely key, and I think one of the messages to each and every one of you as educators of our next generation is don't let that go amiss in their thought process. They need to realize that that is a core competency. And that doesn't mean they're going to be the programmer or they're going to be the specialist, but it needs to be a core competency.
Anybody else?
What I would say, I think that's a great answer, Candy. And what I would say is as we're using more data and using different types of processing like artificial intelligence, it introduces new risks. And there's always the risk that we over-rely. There's always been a risk that we over-rely on systems. And I think the more that we use bots and AI and other technologies, that risk will continue to grow. And so, in addition to finding ways to take advantage of that technology, because it's very exciting to be able to use big data and really see the world from a different perspective, not from a sampling perspective, but from a real population perspective. But how do we make sure that that it's also producing that reliable data that the company can use to record transactions and that we can use to evaluate them?
Just to build off of that, we have advised clients, 2018 is the year that our clients are using more technology at scale as opposed to in the pilot phase. So we, without a question, are seeing our clients use both bots, AI, and heavy data analytics to solve some of these problems, particularly on leasing and rev rec. We have massive amounts of data. The way we're auditing it is we have a tool in the leasing area that is called DataSieve. That's an artificial intelligence tool that will search for key terms and leases that allows our professionals to identify the critical terms on a more efficient and higher quality way. But today's point, it doesn't relieve you of quality. You've got to do it a different way. I'd be remiss if I didn't say, I think all of us in some way, shape, or form are undergoing massive digital upskilling efforts of our people. At PwC, we launched over a year ago a program called Your Tomorrow. It is a $300 million a year investment in our people here in the US to upskill our people. And to date, we've trained 12,000 on UiPath, which is a tool that allows you to do basic bots, Alteryx, and Tableau, which many are using Tableau on your campus. That's just the beginning of the entire digital upskilling. UiPath allows people to do, our auditors to build basic bots to look at an account reconciliation and test it a different way. And that's happening at the client site today. Again, quality has to happen, it comes a different way. But we're going to be sitting here not in 2023, we're going to be sitting a year from now, and we'll see those types of things embedded in the way our teams are auditing.
As well, and you may have touched on this, but I may have missed it, so I apologize if I did. But as you were talking about just the massive implications all these standards have on the control systems and their way of handling all the new transactions, and you touched a little bit on the significant risk aspect. What do you anticipate this all, as we look forward, having as far as volumes of material weaknesses being disclosed in the reports coming from management and then the auditor on the internal control side? It just seems with all the transitions, there's a lot of opportunity for some real weaknesses to appear.
Personally, I think I spoke to it a little earlier. I actually think there's going to be a spike in this. I think it's inevitable that we'll see a greater volume of material weaknesses around recognition, the accounting and reporting side of the house, especially given the volume that the standards have demanded and the bolt-on approach that companies have taken. Companies have taken a spreadsheet approach because, and this has to do with the delayed implementation, meaning companies, I think Jeff said, 6 to 9 months before the standard was due is when we finally started seeing all this activity, and people were still working on disclosure impact in January and February. So you can't have designed the controls, systems, and processes to handle accounting on a recurring basis. So what's happening is that's happening right now. Bolt-ons being utilized, Q1, Q2, Q3, while these systems are now being designed. And as auditors do year-round auditing and look at reliance on controls, these weaknesses will come to the forefront. And it's a wonderful academic thing to do. I'd like to see what the academics come back with from a spike in terms of material weaknesses with respect to accounting and financial disclosure.
You know what I'd add to that is, well, first of all, the good news in all of this is that we have, many, many years, 10, 12 years of reporting on internal controls over financial reporting. Companies who, especially larger companies who've been doing this for over a decade, have very sophisticated systems and have adapted well, even in this environment, even with a spreadsheet approach, which many of them had to take because of the time that they didn't have at the end to get the disclosures or what have you. But the market is made up of very large, sophisticated, well-resourced companies and very small, under-resourced companies. And for those companies, and newer companies too, companies that have gone public in the last couple of years, who may not have the same depth of experience, may not have the same level of resources as Candy referred to. And I think there's a higher risk in that segment of the market that there could be some material weaknesses. I will also say that the more collaboration that goes on between the auditor and the client, you might be able to ameliorate some of those. We can't design controls, but we can certainly raise red flags early on so that things can be addressed before that reporting date on controls.
I think you're both right about that, and just two observations. I think that over the last decade or so, companies have learned what the expectations are. If you're going to implement a spreadsheet to address some kind of a problem, what the expectations are from a control perspective. So even though they're doing a bolt-on, they're doing it in a different way today than they would have done it a decade ago. And so I think there are controls around it. So I think that might help ameliorate the problem to some degree. And also, we did a CFO webcast back in May, and one of the questions was, what are you planning to do on your, from a process perspective? And it was, I forget the percentage, but it was a relatively high percentage of participants who I think realized what they did is unsustainable, and they definitely have plans to implement more systemized approaches. Now that they know what they need to do, they're better equipped to design the systems to accomplish that end game.
Right here.
You mentioned that over time you thought that the CAMs were evolving in the disclosures globally. What do you mean in terms of evolution? Are they becoming more similar for firms within a given industry, or do you see more uniqueness? What are you seeing?
I'll give well, first of all, to repeat the question, when I mentioned that KCAMs that have been reported in the UK have evolved over the last several years, and I'll just give a couple of pieces of anecdotal evidence, and if anybody else has a view, certainly weigh in. The first year out, I think there was a lot of information. There was frankly a lot of fascination around what the auditors were disclosing in the CAMs, and the example that we used, and now I can't remember the name of the registrant, but the auditor actually said that the estimates that were used in the realization of goodwill were they didn't say aggressive, but they were optimistic or something to that impact, something to that effect. I don't think you'll see that word in a
bad words to use as an auditor in your report.
I'm not saying you won't. I'm not saying you won't. I suspect you won't. But you also didn't see that in the following year's report. I think people started to understand how the market reacted to certain language and what was important. What questions did it raise? I mean, there is a question here. This will be the first time, other than a standard audit report, that the auditor has communicated with investors. And if an investor has a question on the auditor's report, they'll go to investor relations. We'll need to make sure investor relations has the information that they need to be able to respond to questions. And there'll be a whole different potential dialogue after the fact that we need to be prepared for.
Zoe?
Oh, actually, that was my question. Dave, you've anticipated it. Could you give a little bit more color on how you expect that kind of dialogue to unfold? In other words, you've talked about the interaction with the auditor's management and the audit committee now. Now that management and the audit committee are seeing what could be potential CAMs, are you getting the question, how are we going to respond to questions we get from our investors? Because the whole point of this is supposed to be to provide useful information to investors. And it's not, I don't think, the procedures that the auditor followed that are going to be of interest. It's actually what, the areas identified and the implications of those. So could you give a little bit more color on how that dialogue will probably unfold?
Well, this is, Zoban, it's a great question, and time will tell. I don't, but I'll give you a few. I always have a thought about something. So I think that that as the CAMs get developed, and especially as they get printed up, starting a year from now, as we've said before, management's disclosures may also evolve to make sure that to the extent that certain things are addressed in the CAMs, that management has addressed them in their language. I would suspect if a question comes up from an investor about the wording of a CAM, management will respond, what was it about it that was challenging, and how has management designed systems and processes to address those challenges, as opposed to handing the phone over to an auditor and having an auditor on an investor call. I don't think that will be happening. So I think that this will it will still be management owning the preparation and reporting of the financial statements. It will just be an acknowledgement that a third party who came in and checked them identified these as the toughest areas of the audit.
Yeah, I agree with that.
So maybe just before we wrap up, I'll give each of you maybe 10, 15 seconds for last comments. And Chris, we'll start with you.
Wow, last comments. Did I say run earlier? No. Preparation. and early involvement, deep involvement preparation, and deep dialogue. And when anyone mentions the words, I think it's going to be easy, it's not going to be impactful, those are dangerous words to say. That's my 10 seconds.
Well, I would say, you know, as Cindy started us off by looking at 2023, there would not only these standards that we've talked about, but the technology that we've alluded to and the technologies we haven't alluded to are going to have such an impact that our profession will change more, I think, in that next 5-year period than it's changed in the last 20 or 30 or 40 years. And I think it's important that all of us work together to seize that change, to make sure that we're on top of it, and for us to make sure we're protecting investors as we go through the process.
I think you all have a phenomenal population of next generation that are really going to make a difference. And whatever you can do to help them think more broadly, to know how important it is to have a plan, communicate that plan, and as you said, Chris, start early, because things are complicated and it always takes longer than you think.
I think the big lesson for me in all of this is take a fresh lens approach to things and don't get anchored in wherever we've been. You think back to you're getting involved in the derivatives space back when those rules changed. It really is a tremendous opportunity for everybody to wipe the slate clean and start fresh. And I think that's an important message to impart to students so that they know, hey, you know what, I'm coming in, I know as much as the partner does.
Yeah, good.
No, that's it.
So I want to echo what the team has said. First of all, I want to say thank you, and don't underestimate your impact. So our oldest is going off to college this year, and he never wanted to do what Dad did. He had no interest whatsoever. And we were at the spring open house this past April, and we're go to the financial accounting class, and the professor was standing at the front of the class. It was packed, and the parents were standing in the back, and he was inspiring them. He was talking about the benefits of accounting. And then he also happened to mention that the accounting graduates make more than any other graduates at $65,000 a year. And God is my judge. My 18-year-old comes to the back and he goes, I think I'm going to try accounting. So with that, you're doing a hell of a job. Thank you very much, everybody. Thank you.